and welcome to Nest Egg's Meet the Manager series, the series where we talk around different common goals in the investment cycle, different things that happen in the market, but more importantly, we're joined with an expert on our panel. Today I'm joined with Chris Andrews. Chris Andrews is the Senior Vice President and Chief Investment Officer for Trobe Financial. Chris, thank you for coming on board.
Thanks, David. Great to be here.
And Chris, I think we were talking around a few different things that we want to mention here. We've obviously seen a lot of different volatility in the market, and there's been a lot of change. But I just want to get a bit of an idea in terms of, what is the discussion today that investors are having to empower themselves in their own investments? I know there's plenty of different opportunities, products, things that they can get involved in. But what is the mentality? How do investors sort of go out there and say, well, how am I financially these days?
Yes, it's a real theme we see more and more of. The self-managed superannuation fund sector, for example, is one really strong example of investors who are really taking charge of their investment future. And that's something really that wasn't around in the world probably even 25 years ago. So what we're seeing at Trobe Financial is we are seeing a really strong growing body of investors, including from the SMSF sector, who are interested in really taking a very active part in their own investment program. So of course we offer those investors portfolios that we construct, that we manage, that we deliver terrific results in, but we then also have investors who wish to overlay investments of their own choice, who wish to choose individual loans, and hence the rise of the phenomenon that's attracted a lot of attention in recent times, being the rise of the peer-to-peer lending and investment space.
Correct, and that's something which we want to discuss quite in more detail today. It's something where, in my experience and talking to a few different people in that space, peer-to-peer lending, very empowering type of investment. Is it classed as an alternative? Is it something where that is an investment where people would use that as a separate portfolio or a complete portfolio, or how would it measure up against their existing investments these days?
Yeah, we'd look at it as an alternative form of fixed income investment. So peer-to-peer lending is where an investor, just to be clear, is where an investor gets to choose the individual loans that they're investing in. So we, as I said, we manage portfolios of loans on behalf of investors, and we've got some award-winning portfolios there that the investors invest in. But then we also offer opportunities for investors to select individual loans, so that they can look at loans from their own risk and return profile. They might be interested in loans with a particular LVR characteristic. They might be interested in loans with a particular yield or duration profile. Whatever their needs and objectives, they can construct the individual portfolio that is specifically tailored to meet their own needs and objectives. Obviously, this is of significant interest to the more sophisticated investor, someone who wants to really be active in their investment program. So we often find it's more the sort of investors who are approaching retirement, who've got some substantial retirement savings behind them and want to ensure that they deploy them to the very best effect.
I think it's one of those things where history and investors look at history. They look at historical data. They look at historical institutions. Peer-to-peer lending, I didn't know about this until relatively recently, but it has been around for a little while, and I think actually as a testament of time, the Trobe have been doing this for one of the longest stretches.
Yeah, so we've been doing it for 25 years. We used to call it direct lending, and that was a form of investment that we've always been very, very fond of. We think it has a significant place in investors' portfolios. In about 2011 and 2012, around that mark, the investment world started talking about it in terms of peer-to-peer investment, drawing on sort of some of the developments in the IT world, really. And what we've seen is a rise now of managers who are styling themselves peer-to-peer. Now that's terrific. It's good to have a vibrant sector. I would only say this to investors: just be aware of the track record and disciplines of the managers that you are investing with. When there is a sector that's going through a bit of hype, as the peer-to-peer sector has over the last few years, you've just got to be aware that you're not investing in fintech, you're not investing in the next Amazon, you're investing in an investment manager. And you've got to be sure that they've got the track record, they've got the disciplines, they've got the asset profile. So many of the new peer-to-peer managers, for example, are investing in unsecured loans. Now, there's nothing in principle wrong with that, but they are by their nature going to be more risky than mortgage secured loans, for example.
No, for
so
sure.
All we're saying is that investors need to go into this space with their eyes wide open, being very, very well informed as to who the manager is and what the investment strategy and resources of that manager are.
It always pays dividends to do your own research, educate yourself, and that's a very important philosophy that we cover.
That's at the hallmark of the peer-to-peer space.
Absolutely. And I think just rolling back a little bit, peer-to-peer, so is this just for anyone that's not aware of the platform or not aware of the actual investment cycle, is this a person-to-person investment? Is this something which they have much more of a self-directed analysis of? Can they really sort of understand what every dollar does in this situation?
What we have on our website is the platform by which our peer-to-peer investors can invest. So you'll see at any one time opportunities, somewhere 80 to 100 opportunities up on that platform. Investors can choose the individual mortgage secured loans that suit their own risk and return profile. They get to select right down to the individual loan. They get all the details of the loan in the supplementary product disclosure statement that they execute to invest in a loan. They can even read a valuation, an independent valuation of the security property that secures the loan that they are investing in. So yes, it's really hands-on control for the investor. Obviously, we tend to see investors not just investing in one loan, but spreading their investments across a number of loans. So the minimum investment that we require in any one loan is $1,000. So it's a very low minimum, which allows and encourages investors to build portfolios. Going back to a theme I know you and I have discussed before, David, which is the importance of diversification. So this isn't to say that diversification is not important, it's to say that investors can construct their own diversified portfolios.
Absolutely, and I think having the mentality of being able to look after that yourself, but also, I mean, you're providing the well-oiled machine of the platform. How do you as a manager coordinate that to make sure that you're delivering the best in the market or best in slot opportunity for investors as 2018 or beyond?
So investors who invest with us, they have the benefit of our platform, and we have invested significantly in one of the really the sector's leading IT platforms to facilitate the administration side, if you like. On the other hand, investors are also benefiting from the nearly 7 decades of experience that Trobe Financial has in this asset class. So we have the ability to originate loans from across the country. All these loans are pre-qualified, so they still go through the same Trobe Financial credit assessment criteria before they end up on the shopping list. Once they're on the shopping list on our website, investors can select from those available investments and execute their investment strategy in that way.
For sure, and I know that you touched on this earlier, a little bit about a few tips on how they can, really sort of make the most of jumping onto this asset class or getting involved. But what would you say your more takeaways or tips for someone who's never understood or never really got involved in something like this asset class before? What would you say are the sort of 5 things to look forward to or keep your eyes out in today's market?
Don't know if I'll come up with 5, David, but let's see how we go. So the first thing I'd suggest is investors really need to make that initial threshold decision. Do they really want to get actively managing their own funds? If they don't, if they prefer to have a manager, we have a lot of portfolios that they can execute their investment strategies through. So that's question 1. Do they want to get really actively involved? If they do, then peer-to-peer is most certainly a sector that they should be looking at. Then they want to turn their minds to what their risk profile looks like. Yeah. There's what interest rate will they be receiving by investing in that particular loan? What's the loan to value ratio, which is another way of saying what security do they have in the event that the borrower who has taken out the loan, if you like, in the event that that borrower goes into default, what is the loan to value ratio? Now our approach at Trobe is to do low LVR lens. So what investors will find is that within our peer-to-peer functionality, our maximum loan to value ratio is 75%. We'd like to have a really healthy buffer in the event that the borrower goes into default. Then investors have got to think about what's their investment duration. Do they want the funds in 6 months? Do they want the funds in 12 months? Are they prepared to take a longer term stake? Maybe they don't need the money for 2 or 3 years. So again, reflecting on the self-managed superannuation fund sector, we find a lot of these investors have quite long investment horizons, and that's in the lead up to retirement, but also post-retirement. They're not after the capital. What they want is that reliable monthly income. So they are prepared to invest for 2 or even 3 years in loans that will produce them that reliable, repeatable monthly income with that significant real asset backing behind it.
Absolutely, and I think one important fact you mentioned there was the risk profiling. And for a lot of investors we speak to, everyone's different. Everyone has their own different levels of risk and what they want to take on or what they're willing to take on. I find that really interesting, the fact that as an investor myself, I can actually empower myself to do that and look after my own risk. I can, I have a very good idea in terms of what I would normally do or what I would like to do, depending on what my goals are, whether I want growth, income, or something like that. When you walk into the world of income and you're looking at that, regular kind of regular payment that you would expect as an investor. Risk profile, does it follow a similar track, or is it the same beast? Is it something which is very different for everyone else?
No, I think what you would find across this space, you would expect a very high degree of month-on-month reliability. Now, so what are the risks? So for a peer-to-peer investor, unlike in a pooled fund, a peer-to-peer investor isn't benefiting, in our 12-month term account, for example, there are over 3,000 individual loans. So if an individual borrower goes into default, really for an investor, that's just noise. That doesn't affect their return. What an investor in a peer-to-peer loan does is they make that trade-off in their mind. They say, well, I can select a really tailored portfolio that will suit me. I can then maybe dial up the yield a little if I want to get a slightly higher return than I would through a managed portfolio. The flip side, obviously, is that if an individual borrower goes into default for a period of time, I may have to wait a few months before I get the income. Once again, though, on the other hand, if I make sure I have significant asset backing, I've got a good degree of confidence that ultimately I will get all that income back. So that's the sort of the trade-off that the investor's making when they're investing in the peer-to-peer model. So we are after that sort of very reliable profile and that really strong sense of capital stability as well. I mean, we're not the first ones to say that a return of capital is just as important as, if not more important, than a return on capital.
Yeah.
And that's something we take very much to heart.
Good quote, yeah, that's awesome. One other thing as well is, the investment cycle, the investment entity itself, it's almost in a way people think it has its seasons, and very much so. Sometimes it does follow suit. There's seasons in the market where certain things do other things and certain things don't.
Yes.
But you can't always work out where those hurricanes or those the earthquakes come into effect. So let's take for example, very much we're all over it now, but the GFC and pre-GFC. How would something like this asset class perform in a market where we don't know, or we have a very sort of big downturn in volatile times? Has it been tested?
This is a terrific question, and this again goes to the heart of our conviction in this asset class. As a manager, philosophically, Trobe Financial is not here to time the market. We don't believe it's possible to time the market. You can pick up big themes, you can pick up big trends, but and again, we're not the first to say this, the market can remain irrational much longer than any of us can remain solvent. So timing the market is ultimately a loser's game. What we believe through this asset class is that we can deliver a highly resilient investment portfolio that will keep delivering for investors whether times are good or whether times are bad. And the GFC is a perfect example of a time where, for investors in many markets, they really experienced hardships. The stock market is still almost 10% down on its pre-GFC levels, and here we are, a decade later.
Yeah.
So, for investors, that's permanent capital loss. That's capital they will never get back. For investors in a diversified portfolio of mortgage loans, regardless of the GFC, regardless of the tech wreck at the end of the 1990s, this has continued to perform. It's performed, we can say, for example, at Trobe Financial, so we've managed cumulative investment mandates, institutional and in our retail pooled portfolio accounts, around $15 billion. We've never lost a cent of capital for any of those investors. We've never had to withhold an interest payment monthly. And for the investors, we speak to, that's got a valuable place in their portfolio. People talk a lot about sequencing risk. So sequencing risk, of course, is the risk that investors will experience capital volatility, as in capital losses that occur at or near retirement. Now, of course, the risk with that is, as we're seeing right now, those losses become permanent because investors have to draw down on their investment capital to continue to live, right, through that period. So what investors need to have is a substantial exposure to these sort of capital stable, income generative investments, and that's where our portfolios have proven to be really resilient.
And it's one of those things where, as a manager, and I always say this about the footy, for example, you got 80 minutes to perform and win, but when it comes down to it, the managers and the coaches have spent way more than 80 minutes working out their strategy. So I know there's a team of over 300 people over at Trobe Financial these days, but is that something which is always being monitored by the team? Is it very much a sort of pack mentality of how they coordinate themselves as a business, and how you're nimble to changing in different market situations?
What we like to have, and where we're a bit different from some other managers, it's probably worth pointing out, is we like to have a lot of sets of eyes on what's going on with our asset pipeline and with our investors and with our portfolios. We believe that gives us the best opportunity to respond to trends that are occurring in the market. They might only be micro trends, they might only be at the margins, but by continually having that really manual, disciplined approach to our asset origination, to our credit process, to our asset selection, to our portfolio construction, we can ensure that we're continually positioning our portfolios to deliver the best outcomes for investors.
To have constant income and have constant investments working the way you want, follow those constants that you believe in as your philosophy.
Yes.
Like you just said, those tips are great. It's something which, as investors, I think it's just having your 2 or 3 or maybe more, whatever you want, ideas of what you like to follow as an investor. To really actually maintain what your goals are, and I think be realistic and be proactive with where you can be in the market as well.
Exactly, and look for those asset classes that are reliable. If you're not a specialist, it's very difficult to follow exotic strategies and to look at, if you like, thinly traded investments. But if you look at, the broad stock market, if you look at mortgages, so the mortgage market in Australia is about 2.5 trillion in funds under management. I mean, that's far larger than the stock market. It's larger than the bond market. It's about the same size as the entire Australian superannuation sector. So those sorts of assets where you have the weight of coverage, and you have really different opportunities that you can take in the asset class, certainly, but a really solid base of quality assets, that's a really important part of ballast in an investor's portfolio.
Yeah, absolutely. Chris, thank you so much for coming in again and having this discussion. I really enjoy having your expertise and your opinions around this, and also a bit of an idea in terms of what we could possibly be seeing in the future. Chris, once again, thank you very much for coming on the show.
Thanks, David. It's been a real pleasure.
Thank you for tuning in. That was our Meet the Managers series with Chris Andrews from Trobe Financial. We've really enjoyed making these episodes purely on the basis that financial education, literacy, and finding out about new asset classes is something which we can always do more of. One thing that I always want to take away is that you can always find more information across our platform, which we have across many different asset classes and everything that you can find across there. For more information around Chris, if you want to follow what they're up to over at Trobe and the team there, you can click on the links below. They're probably in the link in actually the article that you're watching this video on now, so if you could scroll down, you can probably find them there. And you can also get in touch with us here. It's editor@nestegg.com.au. My name is David Stratford, and you can also follow us across on our social media platforms such as LinkedIn, Facebook and Twitter. Until next time, we'll see you then.